In this video, we're going to look at the two appendixes to Chapter 12. The first one showing how we can use Excel to prepare a statement of cash flows, and then we're going to look at the direct method of preparing a statement of cash flows versus the chapter indirect method. So we can use Excel to create a statement of cash flows by using the changes between the balance sheet. So you can see here that an Excel spreadsheet has been shown up. This is also called a worksheet or a working paper that helps us just organize the information needed to prepare that statement of cash flows. So we have the changes between the accounts. So we have a $20,000 increase in accounts receivable and a $14,000 increase in accounts receivable. And then we can see below, we've used the information from above with the changes between the accounts to create our statement of cash flows with our operating activities, our investing activities, and our financing activities. And then that non-cash activity where we purchased a plant asset with a bank loan. The second appendix uses the direct method to compute the statement of cash flows. The difference between the indirect method and the direct method preparation of the statement of cash flows only affects the operating section. The investing and financing sections are exactly the same under both methods. So the direct method is the one that FASB prefers. Companies are allowed to choose, and most companies use the indirect method. The majority of public traded companies use the indirect method of preparation. However, government entities use the direct method. So if you become a government accountant, the direct method is what you would use. So the differences are about where exactly the cash flows came from. So with the indirect method, we make adjustments to the net income based on changes in balance sheet accounts and our current assets and our current liabilities. With the direct method, we say where those flows came from. So instead of looking at the change between accounts receivable, we would say cash received from customers. Instead of a change in accounts payable, we would say cash paid to suppliers. So we have adjustments for revenues and expenses. We look at our operating cash receipts, so the money we get from our services and goods, subtracted by our payments out to suppliers, employees, for operation expenses, interest payments, and taxes. So cash receipts minus cash payments equals the net cash provided or used by operating activities. Our cash received from customers is the cash that we receive during the year. So we have, if accounts receivable increases during the year, then credit sales exceeded collections of cash. And if accounts receivables decrease, then cash exceeded credit sales. And there's a summary of how we do this. So when we're trying to determine what our cash received from customers is, we would take our net sales plus or minus accounts receivable changes. For interest and dividends we received, we look at our interest revenue, and then we add or subtract a decrease or an increase in interest receivable. Then we look at cash payments. So one of them is cash paid to suppliers and employees. So this is all cash payments for purchases and merchandise and operating expenses except for interest and taxes, which are added separately. We look at the cost of goods sold account, that the inventory accounts, and the accounts payable accounts when we're looking at the cash payments for merchandise and expenses. So cash paid for merchandise. We start with cost of goods sold, and then we add or subtract the change in inventory and add or subtract the change in accounts payable. Next, we have cash payment for expenses. So we look at all of the expenses on the income statement, and we would deduct any of our non-cash expenses. So depreciation expense and amortization are non-cash expenses. The other time is those timing differences. So remember that we might have salaries payable or salaries that were the recognition of expenses in the actual cash payment. So we could have a salaries expense with a salaries payable that doesn't get paid in cash until a later time. So we have to look at the payables accounts and the expense accounts to determine when exactly those expenses were paid out in cash, to look at our timing differences. If the payment was made in advance, we would have a prepayment. If the payment's made in the same period, then our cash payment is equal to the amount of the expense. And if the payment's made in a later period, that reduces a liability that we would have had in our payable. So when we're looking at cash payments for expenses, we start with our expenses. Then we subtract depreciation and other non-cash expenses. We add or subtract any changes in our prepaid accounts, and then we add or subtract any changes in our accrued liability accounts. Remember, accrued liability accounts are accounts that where salaries payable would end up in. Then we have our cash payments for interest and taxes. So for our interest expense and our tax expense, we look at our interest and tax payable accounts compared to our expenses. This shows a summary of how we use the direct method to prepare those statements. So this is also a really good graphic to keep in your notes and to keep available to you for a reference when you're preparing that direct method of operating cash flows. So we start with sales revenue. To get our cash receipts from sales or cash collected from customers, we would start with sales revenue and then add or subtract a change in the accounts receivable. For our payments out, we walked through each one of these individually. So we would have the cost of goods sold plus or minus changes in inventory plus or minus changes in the accounts payable. For operations, we take our total operating expenses plus or minus prepaids plus or minus any accrued liability accounts, and then making sure that we remove things like depreciation expense that are non-cash expenses. To employees, we take our salaries expense plus or minus any changes in payable accounts. For interest expense, it's the interest expense plus or minus our changes in interest payable. And for income tax expense, it's the tax expense plus or minus our income tax payable. So we need both the income statement and a previous balance sheet and the current balance sheet in order to prepare our statement of cash flows.